From the wild spectrum of becoming an instant millionaire, from a pocket money investor only to lose it all, to losing the entire life savings on the rug pull of a hyped up crypto token. Major risks exist when investing in crypto if you don't know the do's and don'ts while investing in crypto. Just take a look at these examples where a guy became a Dogecoin millionaire only to lose it all a couple of months later. And when the hit show Squid Game was the buzz, investors lost everything when the hyped up Squid Game coin went to zero. Over the past decade, many crypto investors have made a lot of money investing in Bitcoin, other cryptocurrencies, and digital assets. Investing in crypto with care can make you a millionaire very quickly, and how they did it was knowing what to avoid or what mistakes to navigate to not lose it all. So in this video, we are going to the mistakes others made while investing in crypto, and how you can avoid these 10 common mistakes. Before we get into it, please hit the subscribe button. It's very much appreciated. And welcome to NFT Tutor. This video is purely for entertainment purposes. Please invest at your own discretion. Now let's get straight into it. Number 1. No proper plan. The crypto market is highly volatile and therefore requires investors to have a clear and thorough plan that governs it and protects them from making mistakes. Having no future plans is a negative factor for crypto enthusiasts, causing you to face losses. Bitcoin is an open source network, and developers are working hard to eliminate all the negative factors. More than a decade ago, miners only needed a regular computer to mine Bitcoins. But nowadays, the competition has increased as it's added to the complexity of the mining process. Making money from the crypto market is not an easy task. Investors should have a clear goal and strategy before investing their money in Bitcoin or any other cryptocurrency. Guess your desires, goals, and then enter the crypto world. Number 2. Impatience or emotional during price swings. Speaking of fiat currency, it's a government currency that is issued and controlled by a central bank, which uses various measures to manipulate and control the actual value of the currency. On the other hand, cryptocurrencies are independent because they don't involve a central bank that can control or manipulate the supply or value of money. In addition, the crypto market is unstable, with large fluctuations in the price of Bitcoin and other cryptocurrencies. Therefore, people need to be patient in dealing with price movements. Many investors become desperate when things don't go as expected, leading to further losses. Number 3. Not using a structured portfolio. Many investors make the mistake of not identifying their investment portfolio, which leads to losses. In general, investors need to focus on or identify 3 main profiles: conservative, trader, and moderate. Long-term investors are called hodlers, which stands for hold on for dear life. They are called this because they believe in these investments for long-term appreciation and never risk their money. Moderate investors tend to have different market positions in their portfolios, invest in different assets, and use hodling and trading strategies. After all, traders are individuals whose sole motive is to make money from short movements in the price of the crypto market. Although trading is an interesting method, it involves risk and requires people to have sufficient knowledge. Number 4. Unaware of how to take profits. People enter the crypto market directly without gaining any knowledge of cryptocurrencies and the market. This is one of the most common mistakes new investors make when trying to invest in cryptocurrencies. Investing in cryptocurrencies requires the right knowledge and strategy, as well as an understanding of concepts like blockchain and others. You can easily lose money if you don't even know the processes and concepts of the crypto world. Make sure you have sufficient knowledge and understanding of cryptocurrencies when entering the crypto market, as this is the only way to make money. Never dream that the crypto market will be profitable by investing in it. Knowing the market and taking every step carefully is very important. Number 5. Not diversifying the investment portfolio. Another common mistake when investing in cryptocurrencies is the lack of portfolio diversification. If you concentrate your capital on only one type of investment, you increase the risk of loss because if an event disrupts the financial markets, it's impossible to return the amount invested. The best way to avoid this is to divide the money into different asset classes like Bitcoin, Ethereum, Tether, and other promising altcoins. In this regard, there are many options in the crypto market, but future investors should analyze the possibilities according to their profile before taking any further action. Number 6. Falling for scams. Scammers sometimes email or text victims with investment opportunities. They promise to give investors double or even triple the amount they invested in Bitcoin if they send their cryptocurrency to a certain digital portfolio. Remember, free money offers should always be viewed with great skepticism. Another scam is spoofing. Criminals can easily raise or lower the price of tiny or unknown cryptocurrencies by creating fake buy or sell orders, sometimes increasing the value of the currency by hundreds of percent at a time. When suspecting traders try to take action, criminals will cancel orders that they didn't have to fill in the first place and potentially hurt prices. Sometimes, criminals own a large portion of a particular cryptocurrency by digging up most of it first before releasing it to the public. They can increase the price by promoting it on social media and then selling it on crypto exchanges at a higher price. Then they disappear. And how can we forget about fake coins? With so many cryptocurrencies on the market, it can be difficult to tell which ones are legit and which ones are not. Investing in fake coins allows criminals to steal your identity and often your hard-earned money as well. They do this through phishing by tricking you into clicking a link in an email that installs spyware on your computer. Don't take other people's words and use as many sources as possible for your own research. And here, along with discussing fake coins, let me mention fake wallets too. The best crypto tips will tell you to stick with big names in crypto wallets like Ledger, Trezor, Exodus, or MetaMask. Sneaky or unknown wallets on Google Play Store or App Store can steal your cryptocurrency. And if you're getting value from this, be sure to give this video a like as it really helps with the YouTube algorithm. Number 7. Buying just because the price is low. Low prices are not always a good deal. Sometimes prices are low for a reason. Beware of cryptocurrencies with falling consumer prices. Often, developers also leave projects and are no longer properly updated, which makes cryptocurrencies insecure. Number 8. Not paying attention to the math. The investment is related to the realization of potential profits. With Bitcoin expected to rise in 2022, you need to keep an eye on its price. And how do you do it? Paying attention to the numbers will tell you whether you won or not. You need to check the transaction fees. In addition, because cryptocurrencies can be very volatile, there will be a lot of price changes in a day or even an hour. So you need to consider transaction fees if you want to take advantage of this change. Number 9. Making investment decisions based on emotions. There are a number of acronyms such as HODL, FOMO, and FUD that you will come across frequently when it comes to crypto investing. These acronyms represent a kind of strategy, but at the same time, they are driven by emotion. Let these emotions drive your investment decisions. HODL, as mentioned before, means you keep your investment no matter how volatile the market is. But sometimes you may find that you don't have time to wait for a good return on investment. This is the time to cut your losses. FOMO, or fear of missing out, means buying hype because they just want to follow the trend. Well, this is the most dangerous because there may be night plans or fraud. And FUD means fear, uncertainty, and doubt. As obvious as it sounds, FUD can prevent you from investing in cryptocurrencies even when research statistics or market sentiment favors you and urge you to invest. Number 10. Thinking that encryption means security. Yes, you heard right. Cryptocurrencies are encrypted, but that's just to keep them private, and that doesn't mean they can't be hacked or stolen. These assets are decentralized, so their security is your own responsibility. You've learned 10 common mistakes to avoid when investing in cryptocurrencies. Remember, it's important to know your investor profile, keep plans in mind, and always seek more knowledge. In addition, it's very important to have the emotional intelligence to deal with unexpected movements in the crypto market and never put all your eggs in one basket, but always diversify your portfolio with different digital assets. And if you enjoyed this video and want to get 6 proven strategies to be a better crypto investor, click on this video here to do that. I'm sure you'll benefit from it.